Welcome to the Beat Roundtable. We are going to talk about stocks today and not clothes, and we might mention Jeff's hat again because it's cute. I am Berna Barchet. Today is Tuesday, December 18th, 1 week to the big day. Our group is here and ready to talk the market and investment ideas and Fed meetings. With us today are Charlie Peabody, Jeff Mackey, and Kevin Baker, affectionately known as Banks. Let's start with Charlie today because we've got a little meeting this afternoon that I'm hoping he has some thoughts on.
I do.
You're muted,
So
Charlie.
the FOMC meeting, the FOMC meeting today. I don't think there's any surprise that they're going to cut 25 basis points. I think the market has also been baking in the idea that it could be a hawkish cut. In other words, there'll be something in the dot plot that reduces the number of expected rate cuts in 2025. I think the consensus now is for 3, down from 4. So a lot will depend on what happens in the press conference and how Powell tries to deliver that slower pace of cuts. But we're at a critical juncture on the 10-year, in my mind, yield. 450 has been a resistance level. We're at 441 this morning, and the thinking is that if it is a hawkish cut today, that would be good for containing any rise in yields. But if there is any indication that he's going to continue to cut at a steady pace, I think the bond vigilantes could come out of the woodwork because there is continued concern about the budget deficits, and we did see a very violent, rotational rally in yields, higher yields. Last week when the Treasury issued their monthly budget statement that showed quite a dramatic jump in November. So this trading over the next 3 days is going to be key in terms of what happens to the yield curve from the belly, which is the 2 to 5 year, on out to the 10-year, even if they cut rates on the Fed funds. So using that as a jumping off point, I just want to highlight a few economic releases that all fall under that theme that I've been espousing since August, and that is things that need to be financed are going to disappoint. And by things, I've been talking about, autos, housing, RVs, boats, and by companies, for boats, it's Polaris and Brunswick, which have done very, very poorly. For RVs, it's Winnebago that I think reports on December 20th. For housing, it's things like D.R. Horton, which got downgraded last week by a major Wall Street sell-side firm to sell, which is just unusual to use the word sell for a sell-side firm. And Lennar, which I think reports tonight after the close. And then autos, they've held up fairly well, and so I'll start there. So yesterday we got the retail sales numbers that were very, very strong, but it was really driven by autos. And Cox Automotive had a call yesterday to talk about the auto market, and unit sales continue to be very robust. So that's the positive. The negative is, you look at this blue line in this chart, is that in order to get things off the lot, you're having to increasingly use incentives. And you can see that incentives in that blue line bottomed in the fourth quarter of 22 and have been rising steadily ever since. And we're up to 8% of the manufactured sales price that has to be offered to get these cars moving off the lot. The other thing that Cox Automotive pointed out yesterday is the shift in types of sales. Most of your unit sales now are compacts or subcompact cars, averaging about $33,000 for a price of a car. And that's what's growing. What's literally declining are your full-size sedans type of cars, the ones that average around $54,000 a car. And those are literally declining year over year. But in total, retail sales will be, come in around 15.8 million, unit sales this year. The question is, what's happening to margins in order to get that done? And that's been my thesis. In order to meet your sales goals, you're going to have to increase incentives, which will eat into your margins. And that's, now we'll shift over to housing because I think there are a couple of releases that speak to what's going on there. Um, you know, Yesterday we got the National Association of Home Builders index, which is a sentiment index, and it held steady at 46, which means below 50, there's still more pessimism about that national, about home sales by the home builders than there is optimism. But there are some good points within the release yesterday. The sales expectation did rise to 66, so home builders are becoming more optimistic about sales next year. And I want to go through some of the pros and cons of what the dealers are talking about in that sentiment index. So keeping in mind that the overall index remains below 50, but the future expectations has been rising. Talk about why that's the case. So the negatives are we still have very high home prices, which makes affordability very difficult. Mortgage rates really have not come down. They're still, the 30-year mortgage rate still hovering around 6.9%. So we're fighting that high rate. Construction costs are going up. There's a lack of buildable lots for these home builders, and the cost of labor is in question if Trump does follow through with his deportation threats. So there are negatives that the home builders continue to cite in terms of their cautious. What you saw in this last report was a jump in the optimism about future sales because they're expecting a better regulatory business climate. And that's where all the optimism comes in, is around that regulatory business climate. In fact, one of the subcomponents in this National Association Builders Index was the traffic of prospective buyers, and that's really depressed at 31. So you're just not seeing the traffic. You're not seeing current sales being very strong, but the optimism about the future is there. One thing that Jen put up there was a chart that showed that index and how it tends to lead housing starts. And I don't know, Jen, if you can put that back up, but we are seeing that this shows completions versus starts. And your future revenues are coming from those starts, and you can see that red line is continuing to decline. And we got housing starts again this morning, and they were slightly disappointing relative to expectations, coming in around a little under 1.3 million units of starts in terms of private residential. That red line shows the continued decline. Completions are starting to peak out, and we're starting to see completions, roll over. So if that's your future revenue stream, our starts and completions are rolling over, it's not a good leading indicator for home builders. So I continue to be very negative of the home builders. The XHB is maybe something that is the home builder index that maybe Bakes can talk about. But I've been negative on both DR Horton and Lennar. I think the whole space is in trouble, quite honestly. But there are going to be, Toll Brothers at the high end may do a little bit better than, some of these that have significant entry level situations or significant exposure to Florida and Texas, where there's great weakness. But one last thing I just want to mention on the release yesterday. It pointed out that 31% of home builders cut home prices in December in order to get sales done. So again, incentives having to be given to move product. The average price reduction was about 5% in December. And the use of sales incentives was acknowledged by 60% of the home builders in that survey. So again, that's been the issue, that the gross margins of these home builders are coming under pressure. And I think today, after the close, when Lennar reports, you're going to hear them lower maybe to the 20-21% level their gross margin assumptions. So I'll leave it there. I've talked enough and turn it back to you, Berna.
Interesting. I'm curious, and this is a question for Charlie and maybe the rest of the group, but in terms of auto sales, excuse me, I've got a cough today, staying strong. I'm wondering how much perception or fear of of tariffs and affecting the supply chain and or pricing could be playing into people buying cars right now, because I've heard a lot of people say to me, I was thinking about a big screen TV next year, but I think maybe I'll buy it this year because it might be 20 or 60% higher next year. Certainly with all the noise around Mexico and Canada, which are so important to the auto supply chain. If I was in the market for a car, I would have that in my mind, but I don't know if that may be affecting those numbers now.
Berna, you are very astute. You're spot on, and that was talked about yesterday on the Cox Automotive presentation. If you look at the sales volumes, first, second, and third quarter, they were pretty flat. They were running, closer to 15 million rather than 16 million, and then they spurted higher in October and November. And you were running at a 16.5 million rate in October and November, that area. So the fourth quarter, I think the expectation is a seasonally adjusted sales volume of 16.4 million, but you're going to do 15.8 million for the full year. So it tells you how much sales picked up in October, November, and they did cite the fear of tariffs. So you're right. We may actually be front loading.
There may be a pull forward going on here for demand.
Exactly. And one of the traders that I respect that is starting to look at shorting some of these names like CarMax and I'll leave the names out, but
yep.
Carvana, the most terrifying short in the history of shorting things.
Yeah, this is not a good time to be shorting things into year end. It's a tough one, particularly when the stocks have done so well.
Hey, Berna.
The tax loss, candidates were a good short maybe a few weeks ago, but we're past that now.
Hey, Berna.
Do you have something? Yep.
Yeah, this is Lennar, and it's uncanny, for subscribers that saw the internal chat that we have at 11 o'clock at night, whenever it was. Charlie says, "Hey, I'm going to talk about DR Horton and Lennar," and literally, I'm going through my charts and marking it up in similar fashion to this. If I owned Lennar, I'd be gone 2/3 right now. This close below the 200-day moving average is bearish. The 200-day is turning down, as is DR Horton's. The relative strength is lousy. Look at the volume. I mean, this thing can't find a bid to save its life. Its own mom wouldn't buy the stock. Earnings are going to come out today, tomorrow, and I think they're going to be lousy. And if it takes out this level down here at 142 or so, then I think you have problems. But housing is a bad place to be.
Mm-hmm. Well, I saw Mr. David Maris jumped on since we got started, so I'm wondering if he's got a hot topic for us.
Hot? I have a few topics. So first,
David is always hot.
Yeah, thank you. So first, Viking Therapeutics. I'm not a technical analyst, but look at the chart and you'll say, "Oh, it stinks," and that's why. There's news out today. Merck signed a deal with a GLP-1 early phase Korean company. It's actually a great asset. I saw the poster that they presented just a month or two ago. And it looks like it works. And so this is an interesting compound, early stage, but the GLP-1's getting shaken up again. I had told you last week that I was had a long position on Lilly that I had a tight stop, 5% stop on, and that hit that. So I'm out of that. But just more things going on in the GLP-1s. I would not chase Viking Therapeutics, VKTX. I still don't think that they have a home for their product. Everyone who owns it tweets that someone's going to take them out. Someone's going to take them out. With Merck doing this deal, that takes out another big company that's not going to take them out. So I wouldn't say that they couldn't be taken out, but especially as the stock drops, you never want to bet against that in and of itself. But I don't think that the thesis that this is a great company at a really high valuation is the reason that someone will take them out. So on Teva. I talked about Teva a bunch of times over the last year as a long. They had some news yesterday on a drug, and the stock went up 26%, 27%. And you go, okay, well, that's great. That's a victory lap. Thanks. Next one. No, it's actually, this is a really big compound. This could be a multi-billion-dollar product that could be for several years. So this is very good, solid data. And so the move yesterday was not unjustified. I think that the reason you're seeing it up a little bit today is nice follow through. Usually on things like this, you see people wake up and say, "Oh, I made some money, let me sell." To me, this is actually a really good story where the valuation and the pay down of debt is why you're there. And so I had previously thought that this could be a mid-20s stock. With this positive news, I think it's a $30 plus stock. So I'm sticking with it. And then lastly, on the insurers, Cigna, CVS,
Hey, David,
United.
David, can I stop you on Teva for a second, if you don't mind?
Sure.
First of all, you're being too modest. This is a great call. It held above this 200-day moving average, and I thought it was going to break below it. If this is right, it's got a PE of 8, which I haven't seen in forever. I know it's generics. I used to own this in size. You have a gap up here. You have huge volume, and you have, I think, the dynamic of everybody who's running a healthcare portfolio or has to hug the index and have a healthcare portfolio. Finding a good healthcare stock right now is damn hard, as you well know. And so they're gonna have to say, listen, I got to own some healthcare. What looks good? And they're gonna pull this off the shelf. So you get people that have this memory here from 2015 to 2020 saying Teva stinks, and now they're saying, wait a minute, I got to go into next year and outperform in healthcare, and Teva's looking pretty damn good if this becomes a Copaxone-like contributor to them down the road.
Yeah, I think it's you're absolutely right. What happens is it's like people. Reputations get ruined pretty easily, and then no one wants to be around them. Then all of a sudden you do something somewhat heroic. I mean, you do something right, and all of a sudden the fortunes change, and you can go, okay, I can own this. This isn't a horrible generic company. This is a not so great generic company, or actually an excellent generic company with just too much debt. Plus, they have a couple branded things. They have an antipsychotic that's going to be announced, that's going to be approved next year. That also could be multi-billion-dollar. So you have a turnaround, and I think it's you saw most of the other generics go up too because it's the most hated sector in healthcare next to insurers.
Oh,
and
okay.
I kind of actually like the sector right now, but I do own the most in Teva of the generics. But on the insurers, at some point it's going to be enough is enough. But if you're going into year end, like Kevin just said, if you're going to year end and you're trying to find healthcare companies, are you going to go in after the insurers where the president or Congress just said, hey, listen, we're going to go after the PBMs, where President-elect Trump came out and said, hey, listen, the middleman, we need to go after the middleman. He said it like 20 times that the problem is the middleman. That's not the real problem, but it's a problem. So they're the target. And if you're a portfolio manager, you're going to be like, oh, I want to bottom tick some legislative fix that's going to hurt them that I don't know what it is. No, you're going to wait until at least to see what the new administration does. So to me, they're untouchable. I wouldn't be in UNH, CVS, Cigna. I think I had written about this a while ago that they will end up spinning out their PBMs because they're going to be so toxic. And frankly, none of them are doing a really good job at those, especially CVS. And if I were going to try to stop the bleeding or stop the decline in my stock, one of the things I would announce is a restructuring, especially when I don't need the business. So I would stay away from those. I don't think we're near the end of that. And that's all I had for healthcare. That's why I jumped on.
Well, good to have you here. I'm gonna move on to Jeff, who's got some thoughts on retail as we finally
Santa's
come to
workshop.
the end of endless earnings season.
The endless and glorious earnings season, Bert. I mean, these are magical times at
It's the
retail.
most wonderful time of the
Let's
year.
not be shy about it. It's the most wonderful time of the year. My kids are in town, so I'm having a hard time summoning my inner surly. And frankly, why would I be? The consumer discretionary has been screaming higher and had one of the great ironic bottoms that's gone ignored 2 years ago this month. It was pretty much chalk that we were going to have a monster recession. It was just a matter of when it started, how deep it was going to be, how horrible it was going to be. Since then, consumer discretionary is up almost 90%, and it's shooting for 100% for 2 years. It's the best 2-year run in a quarter century for these names. They continue to trade, really well, but not entirely irrationally. It's Bake says he hasn't seen a PE of 8 in forever. I can give you pretty low PEs at Build-A-Bear workshops. That's up 91% this year. It's still trading at a PE of 11. There's not a want of values. Things are trading reasonably kind of within the realm of a bull market. Nothing's getting too out of hand. We're not seeing the short squeezes go on forever. And so, there have to be picks out there. And I'm trying to build a basket of 3 that haven't gone off to the races right now. I guess we can start with the Bake's favorite because it's been trading well. Bernie, you nailed the trade. Abercrombie. That's a good example of how these names are trading well. Now, they reported great earnings. The stock is up 10 bagger for the last 5-6 years, so no one wants to give it that much credit. But if you see the reaction to earnings, got up to 163, pulled back 30 straight points. You and I were talking about it on the chat. You got long, Berna. It behaved kind of the way it should. Came into the support, had met the upline, and people came in and bought it. This is a stock that's digesting incredible gains, and it's still trading at a PE of 15, with all, hitting on every single cylinder that it can have. Now, the argument is that there's no more upside catalyst. The argument against that is, man, you just don't see double-digit comps and these kind of margins. They're screaming. They're clearly winning Christmas. I don't want to bet against them. Bakes, what say you, man?
I'm glad you brought up the 5-year because, that gives a context. If you go up as much as this stock has in 5 years, you deserve a rest. It's just common sense. You dazzle people, you surprise people, they get full, and then you consolidate. And this is a decent consolidation. My one thing is, because I'm I've had this dog bite me, so I don't let him bite me twice. I keep saying the same thing over and over again. Close below the 200-day, sell a third. The 50-day comes down through the 200, sell another third. The down volume picks up a little bit, and the up volume is okay, not great. Now, if it takes out this 168 convincingly and this 173 convincingly, then all bets are off. But when I see this, I get concerned that, if they come in with a comp that's 18, not 21, do people say, well, what have you done for me lately, and go on and do something else? So that's the only nit that I'm picking here. But given the long-term context, look at this chart. That's a staircase. That's a stairway to heaven right there. So this is a staircase that's questionable for now, but I would hold on to my third and get ready to top it off if I really believe the comps continue.
It's not a damn thing as a stock or just as a motivational story or as a wealth building and creating vehicle, which is the same, I would say, for Costco. I would say that for Walmart, stocks that have just gone up so much. Those two have just gone up on multiple expansion. So I'm looking for ones that have it. Bakes, you want consolidation? What if I were to tell you that a name brand mall store hasn't moved an inch since 1998? I'm talking about the Gap, baby. And this is also a dog that, man, has a piece of my butt in it from about 10 different times where they've tried to turn this thing around and just has not come together. I think that the new CEO, Richard Dixon's finally talking the right language in terms of what the fundamentals are going to be. He's saying outright what he's going to do. We're going to have these deliverable goals, and I'm going to hold your feet to the fire. I'm going to close stores if they don't work. We're going to go after the athleisure market, which he identifies as a $70 billion opportunity that, frankly, Athleta has done so very little to chase. The expectations are low where you're looking at just any kind of positive comps, and they're so very close. They were a whisper at banana from having all their stores go positive comps for the first time since probably 1998, give or take, or 2000 when they peaked. I mean, it's been a while. Let's just say it's been a while. But they've got a ton of different levers. I like that stock for the next year. These are stocks that I kind of just am willing to put away, put up with some pain in the context of insane consumer discretionary behavior. I'm looking for stuff that's not overbought, not yet widely loved. I think Gap's going to be one of the stories for next year. That's my first pick. I like him here. I like him long. I think you can build a position. I think Dixon's the real deal. And he's kind of coming into that prime new CEO thing where he's been there for long enough that people gotten to know what he's about. And I like his moxie. I like what he's doing, and I think he has all kinds of levers, and I think we're in the prime of his executive run here. So it's a chance to get long something that hasn't run yet. That's my first pick. We can take
okay,
up.
I'm going to
hold on a second real quick. Jeff.
Can I intervene for 1 second? Because Jeff and I agree on almost everything. And this one...
And sometimes you're mistaken, Berna. It sounds like you're about to make a mistake. You might want to rethink it. Are you sure?
I might make a mistake. I don't know. I think... I mean, partially, I think I'm sort of wrapped up in the fact that I remember like 10 years ago, I did a thing of let's look at this company and they, comps for the last 10 years. And like 10 years ago, they had only comped positive twice in 10 years. And I don't think the next 10 years were much better. So there's a bit of that, so they need to pull, a rabbit out of the hat, in a way that like Abercrombie did. It's not unprecedented. I would say like 25 years ago, Coach did it when it got spun out of Sara Lee. It does happen, but it's rare because momentum and, is real, like in
super
business,
rare and
in retail. Yeah. So there's that. And then I'm also Dixon. This is the one who came from Mattel, right?
Is that I
follow Mattel, and I have found those guys, that whole management team, to be a overpromise and underdeliver. So
it's a proud tradition. I think they have overpromise and underdeliver in Latin on the headway of the door at the Gap offices. I mean, this is a company that has underdelivered for, again, decades.
Yeah. So I mean, I guess
26-year chart.
So I'm a little, and I mean, you could have gone bowling in Banana on Black Friday, but I don't know about this one, but I wouldn't short it because Jeff is long it, but I'm a skeptic, and I think
some people go into a store that looks like it was frozen in amber in 1998, and they say, "Boy, this is a disaster." Other people say, "Look at the opportunity if we update this by, say, a decade or so." I'm in the latter camp on Gap. I'm sympathetic to your point on the failed turnarounds. I actually had a friend on Twitter who agreed to assassinate me if I ever got long the Gap again. I had to get special dispensation to buy it here. I had to say, listen, man, it's been a while. I've had that deal with him for the last 6 years since the Canadian guy came in. The problem with the turnarounds before, they haven't been willing to close stores. They still have way too many. They haven't been able to really kind of do the extreme things, and they haven't come up with firm deliverables. They had too much respect for who Gap used to be. And they spent 15 years just kind of mourning the days when Mickey Drexler would kick the crap out of estimates every single quarter, like Jack Welch, only in fancier clothes. And they've just been lost. They've been promoting from within. What I like about Dixon is he doesn't have any idols there. And it's just a chance to keep them going. It's a chance to kind of build the business from where they are now rather than where they were in 1978. So that's basically my top pick for the next year. We can go to the other two if you'd like to.
Jeff, hold on 1 second. Jeff.
I'd like to add a piece to the puzzle too after Biggs.
The number one, I never heard friend and assassinate in the same sentence before, so that's a Wall Street beats and
you don't want your
first.
enemies to agree to assassinate you.
You got to get better friends. Anyway, the 50-day is crossing through the 200-day moving average right now to the upside, and that usually signifies a pretty significant trend change, and they like this last earnings report. So if you see some follow through, certainly above 28, 29, and 31, then I think you're off to the races. But the moving average is a big trigger, and a lot of people have automated systems where anytime that happens, they say, "Hey, let me take a look at this." Especially going into a new year, I've got to own some retail that hasn't run up like it's Costco. It's a 12 PE. Let's talk about it. So I think that dynamic's going on here.
Yeah, and I'm looking for stuff that's still warming up. I've got plenty of retailers that have been off to the races. They're looking a little gassed right now. So Biggs is on my side. Berna's against me. Charlie, what do you say?
Well, I was going to add, so Goldman Sachs banking conference just concluded last week, and Brian Moynihan, the chairman of Bank of America, spoke. And you got to keep in mind, Bank of America banks 1 in 4 U.S. consumers. So they have really good consumer data. And he was making the distinction, while spend had slowed to a mid-single digit rate, it was still very healthy. But he said what was interesting from their data is the spending on clothes at the margin was quite strong. Now, I know there are different types of retailers, but as a general category, spending on clothes was continuing to be quite strong. And interesting, spending on luxury items was starting to slow. So maybe the Gap does fit that theme.
They should, right? Like they really kind of, the Old Navy should play to that really well. It should play to people that just need new clothes, because every once in a while you need to buy a new set of jeans. Gap has left so much on the table just through poor execution, through just weird stuff like the Yeezy thing. Holy Remember they were going to let Yeezy sell stuff in garbage bags on the stores. That was
Stock doubled on
idea.
that news originally, though. Remember?
It's boy, not with me on board.
Don't say negative things about Yeezy.
Oh boy,
It's
that's
not
a whole
cool.
different.
Not cool.
Hey, do you have good things to say? Anyway, we're hoping for the best. Godspeed to Yeezy. I
Yeah,
want to talk
musical
about other
genius.
picks, or should I save them for later this week as we count down for Christmas? My mom used to like to dole out the presents super slow, and I kind of inherited that quality of her. You like to milk Christmas a little bit, so we can save the gifts. Berna, what do you want? What would you like from me?
Oh, what? Let's do one more. One more.
Peloton. Yay! Listen, that's been my favorite stock of the year, mostly because I got long in again for the first time in 2 years, about 5 seconds before David Einhorn, the hedge fund manager, was nice enough to ride a Peloton bike at the Robinhood stock picking conference, and he sent things ballistic. My kids thought I was a genius. I'm like, I had no idea the weirdo was going to do that, but God love him for it, and that was terrific. This is another one where, like the Gap, they've been run stupid so long that they don't really know what smart looks like yet. And you got to reevaluate the business once you do. They've found more expenses to rip out of that place after trying to kind of do it in a half-ass way for the last 2 years. They finally got serious about it, and they turned cash flow positive, or turning cash flow positive, so much faster than people thought possible, without really seeing that churn go up. And so you're left with what they should have been for the last 2 years, which is not a growth company, because you know what? You pulled demand for stationary bikes forward by about 500 years during COVID. Stationary bikes will never be that popular again. You're not a growth company, but you're not clothes hangers either. You have a loyal user base. You've got relatively low incremental costs for kind of rolling out new content. You're just paying someone to basically do cardio in front of people. You have a sticky as hell product that you haven't marketed well, and you have a lot of expenses you need to rip out. You know, this company still spends something like $50 million a year on research and development. I'm not sure what they're researching and developing, but you know, it's sort of app updates, which you could hire a bunch of stoned kids to do from their houses. You know, it's there's not much there. I'm saying there's plenty of meat on the bone. They can get out of their retail contracts. They can stop making clothes. I feel like the stock is still under-owned just for past sins, which they deserve. Things could fall apart, but if they're able to come anywhere near their goals in terms of producing bikes in a more rational and more efficient way, and again, the tech on the bikes has not been upgraded for at least 5 years. You know, it's they can do product refreshes and just holding the customers that they have. You got a great cash flow business that really has kind of more room to run. Now, this isn't going to go back to 140 because stationary bikes, not a $50 billion market. I'm sorry to disappoint, but it can certainly kind of go up another 50% from here over the next year. Now, this is going to be bumpy. There are a lot of people who are trapped long it because they don't want to sell with the gains until the beginning of the year. So this is a stick it in a drawer and see how it goes. And also show up tomorrow because I'm going to be doing my 3,500 Peloton ride since April of 2020. So I think it's a decent product. I think it's a pretty good stock. I'm just happy to be there.
Congratulations on 3,500. That's quite an accomplishment.
Very
and
nice.
a little disturbing even to me. It's a little OCD. I'm not gonna lie. That's a lot of riding, but you know, it's also I like having veiny legs. I look cool.
And you know, I will toot his horn for him. He's usually in the top 5% of the leaderboard too. So no
I'm the Lance
slacking.
Armstrong of
No
old
slacking
guys
on the
riding in their
3,500
Peloton
ride.
Nook.
So, Bakes, did you have anything that you wanted to talk about?
Yeah, no, I'll go through it quick because I know we're pressed for time. But I like the humble brag of Morris yesterday. Oh, I just came from a run in my T-shirt, and Mackie today. Oh, I'm just doing my 3,500 Peloton ride, and I'm going to go lift some weights later, I guess, because I just feel guilty. Anyway, all right, copper stinks. First of all, I love doing this. I got home late last night, and I'm going back and forth with David and Charlie, and our subscribers can see that internally. The interplay between the technicals and the fundamentals, I think, is invaluable. I hope you find it valuable. But the end of the day is that we make money. Here's my and I don't think I talked about the buy because I joined after this, but I bought this around here, and I'll do this for simplicity's sake. And I had another buy and a couple of the sells. But the bottom line is that when I open my statement and I see down 15%, I don't care what's going on. I sell it. So with the sales over here, I'm down 11% and I'm gone. It was a tiny position by the time I sold the last of it, and that's my point. I have a sell discipline. I'm happy to teach it to other people. Maybe you don't like it, but I don't have anything down 15% plus, and most people do. And I know how to sell because I've studied this, and I've just gone through the agony of spending 80% of my time on 20% of my losers. So I get rid of the losers so I can just find great stocks to supplant my good stocks. So this is the sausage making. Economists can't pick stocks. I believe that down to my bone marrow. I'm sure there's 3 that I haven't met that do it, but copper's a pretty good economist. I don't know what to read into this. I'm not going to read too much, but copper stinks, and steel got slammed on the Nucor news yesterday. So metals aren't looking great. Lastly, unless you guys want to ask about something, pictures of Lily, John Entwistle on the French horn. This just doesn't look good. This is a sell to me, and I'm happy that David came on. I'm happy that he's out. I have voiced my concerns about this for a while. Here's the first sell here, below the 200-day moving average, the close. The 50-day closes down below the 200-day here. And so, you're talking about prices 800 plus to get out of these things initially. And then the coup de grace is this 200-day turning down. And, a cynic to me would say, hey, maybe someone learned about Merck and, just another competitor coming up. And this is and my tiebreaker here is these volume levels here. Look at this, the down volume. People are leaving this building. And so goodbye, Lily. Full disclosure, I'm not short, but I pointed out because it's number 12 or 13 in the S&P, depending on the day. David had an interest, and I think this is a sell, in my opinion.
That's a nice Who reference as well. The pictures of Lily. That was good. I don't remember them having a song with a sad trombone though.
Now I'm pretty sure it's Entwistle on a French horn. I'm almost positive.
You are. But the Lily chart looks like a womp womp to me, which is a whole different song.
Yeah, but see,
you guys are talking up the Who and talking down Yay. I can't have any more of this.
Wow.
I had no idea you were such an enthusiast, my man. That's great.
All right. Lastly, ELME is this is the artist formerly known as Washington REIT, and it has, full disclosure again, it's got a 4.5% dividend yield. I don't short stocks that have, you got to make 5%, between the yield and the borrow in order to make some money. But here is a high volume break below the 200-day moving average, and they own office and retail and multifamily around DC. The relative strength line hits a new low. It goes below the Mendoza line here at 49. The volume picks up. And I'm going to say that Charlie talked about all the concerns about the deficit. I think the deficit is going away. I know that sounds extreme, but I think that Doge is for real. I'm telling my son and his fiance, don't buy a house anytime in DC anytime soon. And I think I'm doing a public service.
Bakes, on that front, M&T Bank has done very well if you look over the last 2 months, 3 months. But
symbol, please, MTB?
MTB, yeah. But recently it's seen a little softness and concern about housing and commercial real estate in that DC area is one of the reasons that's being cited. I don't think it's a reason to sell the stock, but it is creeping into the price.
Yeah, I don't think either. And I also, General Dynamics, I like to do things in 3. Comedic timing, the Holy Trinity, and Stooges all should be done in 3s. And General Dynamics is also rolling over as well. So the defense stocks are starting to sniff out that they're going to have their income statements whacked for the first time in forever. And we'll see what happens. But you heard it here first. And I'm doing this, frankly, because I want us to have highlight reels that we can play over the course of 2025 that showed to subscribers we're pretty good at this. We make money. We're about as subtle as a 2x4. At least I am. And we've been right on Doge, and I think we're going to get even more right as 2025 unfolds.
Hey, Bakes, can you go back to your junior copper charts? I mean,
Yeah.
are you strictly bearish on juniors?
No, I hate them all.
I'm assuming that China has something to do with that, or maybe housing. I'm not sure. But
here's the same company's ETF with the bigger companies. They look the same. Usually the junior miners, if you're right, you get more leverage because you have money flows and hopefully some explosion of the bottom line when the top line rips. But here's Freeport McMoran, the granddaddy of them all, Keith Jackson, and they all look lousy. They all look lousy. So copper is going down.
Got it. And on that, I'm gonna wrap it up because we're running a little over time. But thanks for joining us today. If you like what you heard, there's more on there, including written research, our chat on wallstreetbeats.com. So I'm Berna Barchet. We'll be back tomorrow, and thanks for being here.
Thanks, Berna.
Thank you, Berna.
Guys,
Thanks.
Thanks, everybody.
Thank you, guys.
That flew by. It was a fun little chat.